Good. Okay, welcome back, everybody. Today we're going to be starting Chapter 3 of Intermediate Accounting. So, Chapter 3 deals with review of a company's accounting system. Okay, so reviewing a company's accounting system. Okay, these are going to be the objectives for this chapter. Today we're going to get through, I believe, the first 3 of these objectives. So I'll just read through these 3 and then we'll go ahead and jump right on into it. So today we want to understand the components of an accounting system. Also know the 5 major steps in the accounting cycle. Then we want to record transactions, events, and arrangements using journal entries in the general ledger. Okay, so those are the 3 objectives that we're going to try to cover in today's lecture. So let's start with the accounting system. What is the accounting system? So it says here, the primary purpose of a company's accounting system is to record, organize, summarize, and report useful information to external financial statement users and stakeholders, as well as to company managers for making operating, investing, and financing decisions. Okay, so the accounting system pretty much is just going to organize all this data that a company accounts for, right? With the transactions and different events that takes place throughout these different accounting periods. So accounting system is very useful. Really saves companies a lot of time and money. Basic components of an accounting system are going to include the accounting equation. Now, the accounting equation is actually going to be the framework or the backbone of this system, okay? So that's going to be the framework of the system, that accounting equation. Remember, assets equals liabilities plus equities. Source documents used to generate accounting information. So source documents is going to be the documents that are used when we make transactions. So those are source documents. Then we record records used to organize and store accounting information. So we're going to use those records to organize and store accounting data. And the outputs, so the output is the financial statement. So obviously the output of the accounting system, the overall goal of what it produces is the actual financial statement. So pretty much the accounting system is just going to use the framework of the accounting equation, take the source documents, right, and then use those records to organize and store accounting information and ultimately put out the financial statements. So this whole accounting system is just a way of just having better internal control over financial reporting and making sure that the system is operating the way that it should, so that the statements are going to be as accurate as possible to the users and stakeholders, as well as the managers as well, for operating, investing, and financing decisions. Okay, so let's talk a little bit more about the accounting equation. I know this is the very first thing that everyone learned in Principles of Accounting 1. Very important. We can never escape it. Obviously, that's why we're talking about it again here. So once again, the accounting equation is the foundation of the accounting system. Once again, the accounting equation is assets equals liabilities plus shareholders' equity. Assets are going to be the company's economic resources, right? So assets is what the company uses to be able to produce revenues, right? Liabilities is going to be obligations owed to creditors and other sorts of people that have lended us money, right? So assets, company's economic resources, liabilities, obligations owed to creditors. And then lastly, the shareholders' equity is just the residual interest in the company's assets after the liabilities have been satisfied. What I mean by satisfied, so after they've been paid off, right? So after we've paid off these creditors, what's left over, so the net assets. So shareholders' equity is also known as net assets. So assets less liabilities equals net assets. And in essence, it's the same thing as shareholders' equity, because it's the residual interest in the company's assets after liabilities have been satisfied. So shareholders' equity, same thing as net assets. Once again, accounting equation is the cornerstone or the foundation of the accounting system. And the equation is assets equals liabilities plus shareholders' equity. So let's talk about some of the components of shareholders' equity. We'll start with contributed capital, okay? So this is the amount of capital that is invested by the owner. So once again, that's contributed capital. Next, the next component, retained earnings. This is the cumulative amount of net income generated by the company minus dividends distributed to the owners, okay? So retained earnings. So once again, we know net income. That's the end result of determining our income based upon differences between revenues, expenses, gains, and losses. We're either going to have net income or net operating loss. Okay, so that's what they're talking about, net income. What happens on your income statement, the end result of that. And then dividends. Obviously, we know dividends is what the earnings we redistribute to owners. Okay, so the component of retained earnings, that component of the shareholders' equity, once again, is the cumulative amount of net income generated by the company minus the dividends distributed to owners, okay? So the ending balance in retained earnings is going to equal the beginning balance in retained earnings plus the net income earned by the company less the dividends that are paid by the company to the owners, okay? So once again, the ending balance in retained earnings is the beginning balance in retained earnings plus the net income for the period minus the dividends declared and paid to the owners by the company. Next, we have accumulated other comprehensive income, known as AOCI, and other comprehensive income, which is known as OCI, okay? These include income items that the FASB has designated to be recognized as a separate component, okay? Right now, we're not going to get into these different components of what make up accumulated other comprehensive income, other known as AOCI or other comprehensive income. For now, just know that net income plus or minus AOCI equals OCI. Okay, and once again, we're gonna get into these components of accumulated other comprehensive income and other comprehensive income later in chapters 4 and 5. So for now, just know that they're there. Let's talk about the components of income. So once again, remember these components are going to be presented on the income statement, all right? So these are going to be components of income. So we have revenues, right? It measures the inflows of assets by the settlement of obligations from selling goods and providing services to customers, okay? So once again, revenues, this is the money we're bringing in from providing goods or services, right? So it's once again the measure of the inflows of assets and the settlements of obligations from selling goods and providing services to customers. So the revenues is going to be the main purpose of what the company is in business for. If it's a service industry, a service company in the service industry, then their service, whatever service they provide, is going to produce revenues. If we're a manufacturing company, whatever good we manufacture, whether it be tennis shoes or furniture, whatever it might be, toys, that's going to be our revenue producing our revenue producing activity. Expenses. This measures the outflows of assets that a company consumes and the obligations a company incurs in the process of operating that business. Okay, so expenses once again measures the outflow of assets that a company consumes. So if we consume an asset, it's going to be expensed, right? Or we might take on an obligation, right? And we have to recognize that as an expense as well. Gains and losses. These are going to be peripheral gains and losses, so it's not going to be tied to the direct revenue producing activities. So these are going to be like from dispositions of fixed assets from the company. So if we would sell something for more than what, say the fair value is more than the carrying value of the company, we would incur a gain just from the disposition of that asset, because we received more than what we were carrying it on the books for. The flip side of that coin, or other opposite side of the spectrum, if we would sell it if the fair value is less than the carrying value or our reporting value, then we would incur a loss. Okay. Another thing that could trigger a gain or a loss would be if we were holding trading securities, right? For the means of trying to earn a profit based upon the changing in their fair value on the relevant trading market or trading platform like the New York Stock Exchange. So if we're holding securities there, at the end of the period, we have to determine whether we've made a gain or a loss, like a holding gain or loss for that period. So those are gains and losses. Difference between gains, losses, revenues, expenses. And once again, these are the components of income. So these components are going to enter into the determination of whether a company has net income or a net operating loss. Let's talk about the accounting equation. Let's go ahead and expand it. So this is the expanded accounting equation. Once again, what's the accounting equation that we're concerned with here? It's assets equals liabilities plus shareholders' equity, okay? So that's the basic version of it, right? Then you can see here the expanded accounting equation is down here. Once again, it's assets equals liabilities plus shareholders' equity. And you can see it's all long and drug out here. You can see we haven't expanded on assets. We haven't expanded on liabilities, right? So throughout all this stuff we're about to go through is all an expansion of the different components or elements of shareholders' equity, okay? And how different things that we've talked about with revenues, expenses, gains, and losses and all this affect this accounting equation. So once again, let's start at part A right here. We have assets equals liabilities plus shareholders' equity. That's the basic equation, okay? Let's expand on shareholders' equity. So what are the components of shareholders' equity again? Recall we had contributed capital, or remember this, the money the owners are putting into the company. Retained earnings, right? Retained earnings are what? Beginning retained earnings plus net income minus dividends. Remember, because we have our beginning balance of retained earnings. Retained earnings is only affected by two things: net income, so the money the company made, and the money that they paid to their owners, right, which is dividends. So once again, retained earnings, beginning retained earnings plus net income minus dividends, okay? Accumulated other comprehensive income, we can see the components of that is beginning accumulated other comprehensive income plus other comprehensive income, okay? So that's accumulated other comprehensive income. Okay, if we look down here on the expanded equation line one more time, if we dig a little deeper, what exactly is net income here? Because remember, with dealing with retained earnings, net income is a component of it. How do we find net income? Remember, this is going to be the revenues minus expenses plus gains minus losses that we just talked about. Remember, those are components of income. That's why we're seeing them here. Okay, so pretty much that's what we've expanded on, how each of these different components affect shareholders' equity. You can keep getting deeper and deeper of that of retained earnings or accumulated other comprehensive income. Out of retained earnings, we can dig deeper into the net income. Okay, so that pretty much this is just breaking down, being more pervasive, going deeper and deeper into the equation of how each element affects, because we know within an accounting system, every element is going to have an effect on another element. What do I mean by that? So assets, liabilities, equities, revenues, expenses, gains, and losses all are interrelated in how they affect one another. And we can see that by looking at the total expanded accounting equation here. Remember, assets equals liabilities plus shareholders' equity. So let's expand it. Shareholders' equity is going to be contributed capital, right? Money the owners put in, plus beginning balance of retained earnings. So the beginning balance of this from the prior period. Then from there, we need to add revenues, back out expenses, add gains, back out losses, back out dividends, and add back beginning accumulated other comprehensive income plus other comprehensive income. So you can see here they're all interrelated, which is ultimately going to affect this original accounting equation here. Okay? Just spend some time on this, look through this. It really helps to understand these different components and how they flow through and how they're interrelated and how the effect of one has an effect on another. Okay? Okay, now let's talk about how business activities change the accounting equation. Okay, so let's look at the very top here. This is the beginning of the year period, or beginning of the period, year zero, right? So we have just assets equals liabilities plus contributed capital plus retained earnings plus AOC. So pretty much same, just the accounting equation. Assets equals liabilities plus equity, right? So let's say first, remember this is business activities, how they change the accounting equation. Let's assume that we acquired assets by issuing debt. So obviously assets are going to increase. You can see here, we're still just punching in off this accounting equation here, coming down. Assets increase because we've acquired assets by issuing debt. So that means assets are going to increase, and we issued, by issuing equity. So also contributed capital is going to increase, right? Because we've acquired assets by owners putting money into the business, right? So assets increase, equity increase, in particular contributed capital. Next, what if we acquired assets by issuing debt? Once again, assets are increasing because we acquired assets, but now the way that we've acquired them was by issuing debt. So now we're going to increase our liabilities. We've now incurred an additional liability, right? Because we acquired assets by issuing debt. Assets increase, liabilities increase. Now let's say that we use assets to retire equity, okay? So if we use assets, we're consuming assets. So assets are going to decrease. And we're using the assets to what? Retire equity. So our contributed capital is going to decrease because now we've actually retired some equity now. So we paid back some of the equity or contributed capital that they originally put in. Next, using assets to retire debt. Once again, if we're consuming assets or if we're using up assets, assets are going to once again decrease. And why again are we using or consuming these assets? It's for the purpose of retiring debt. So if we're retiring debt, then liabilities have been satisfied, so they're going to be reduced as well. Okay. Now, what about if we're going to be generating net income? What about revenues? Revenues create assets, right? So if revenues create assets, assets are going to increase, whereas retained earnings are going to increase, right? Which is a component of stockholders' equity. Because remember, revenues, net income is changed to retained earnings, so revenues is going to increase retained earnings. What about revenues satisfying obligations? Okay, if revenues are satisfying obligations, then obviously obligations being satisfied means liabilities are going to be reduced. And if revenues are satisfying obligations, then retained earnings are going to be increased because revenues are increasing, right? Because remember, net income closes to retained earnings. Revenues increases retained earnings. If revenues increases net income, if net income increases, retained earnings increase. That's why we're seeing the result right here. Okay, what if expenses consume assets? So now we've incurred expenses that have consumed assets. Okay. So obviously assets are being consumed, so they're going to decrease here. And obviously expenses are going to reduce your net income. And if net income is reduced, retained earnings will be reduced. So expenses reduce retained earnings. What about if we have expenses incurred for obligations, right? Expenses incur obligations, right? So now the liabilities are going to increase because we've incurred obligations, right? Once again, expenses reduce our net income, and net income obviously is close to retained earnings. So if expenses reduce net incomes, expenses reduce retained earnings. Gains create assets, okay? Obviously, if we are creating assets, assets are going to increase. Gains, once again, gains increase net income. Remember, they're peripheral. So we're going to increase retained earnings. Losses consume assets. So obviously, if we're consuming assets, assets are going to decrease. And if we're incurring a loss, then it's also going to lower net income. Net income's close to retained earnings. If we're decreasing net income, it's going to reduce retained earnings. Now, what if we're going to pay dividends to some of the owners? So obviously, if we're paying dividends, we're going to pay that with cash, which is an asset. So assets are going to decrease. And retained earnings are going to decrease, obviously, because remember, if we go back to the formula, retained earnings actually paying dividends actually reduces your retained earnings. Okay, and then on the bottom here, end of the year prior one, we can see the changes in assets and liabilities, contributed capital, retained earnings, and accumulated other comprehensive income. Back to stage one here. Besides now, we're at the end of year one, which is notified by the one right here, or signified. I'm sorry. So once again, this is how business activities are going to change the accounting, are going to change or affect the accounting equation. Okay, I would definitely spend a little bit of time on both slide 8 and 9 because this really does just break down the different components and how they flow. And this is how business activities change and affect these. So this is going to really help you understand how information is flowing from one financial statement to another. These two charts are. So these are very important. Okay, next, let's talk about transactions, events, arrangements, and supporting documents. So what is a transaction? Okay, I think everyone knows what a business transaction is. Okay, you give up a certain good or a service of certain value and receive some type of something in exchange of value, whether it be stock or cash or whatever it might be. So a transaction is the transfer or exchange of resources between the company and another party, right? One company usually receives stock or cash, the other one usually receives some type of an asset or a service, right? A good or a service. What about an event? Okay, this is an occurrence that affects the company. So an event, something that affects an occurrence that affects a company. So maybe an event is we disposed of a fixed asset. That's an event, an occurrence that affects the company's position, right? Because we've now got rid of an asset and we've probably received something in exchange for it. Okay, so that's an event. What about an arrangement? Okay, this is going to be an agreement or a promise by the company with another party. So maybe we have an arrangement with the company, like maybe we have a supplier and we have an arrangement to where we guarantee them that, you know, every month we're going to purchase 100 units of whatever goods that they're producing for us. Okay, so that's like an arrangement. We've just arranged with that company, so therefore we can account for it and prepare for it a little bit based upon that arrangement. Next topic here is source documents. These are going to be business documents that record transactions, events, and arrangements within an accounting system. So once again, source documents, like if I would sell something to someone, like we would have like a receipt or something of that sort. So it's something of a source, like, so it's a document from the source of that transaction. That's how we actually account for stuff and record those transactions, just by looking or using these source documents. Okay, so these source documents come into play and are very important as well. Let's look a little bit of the account terminology. Okay, so accounts, this is just going to store recorded monetary information from transactions, events, and arrangements. Okay, so that's where we're going to actually record transactions, events, and arrangements, is within these accounts, right? Now, a chart of accounts, this is just going to be a comprehensive list of all accounts and their assigned account numbers. So once again, a company will have a chart of accounts. Assets might be listed as number 5. Liabilities might be listed as number 10, equities as number 15, so on and so forth. Expenses, 30, whatever it might be. So that's just a chart of accounts. It's just a comprehensive list of all accounts and their assigned account numbers that are relevant to a company within their transactions that they account for. Next is T accounts. This is going to be a format used to show debit and credit sides. So I'm sure everyone is familiar with the T account. It's just looks like exactly what it says, a T account. It's just you draw a T. Above the T is going to be the actual whatever account it is, whether it's cash, accounts receivable, inventories, prepaids, whatever it might be. Okay, so then on the left hand side we'll have the debit, which is saying the left side of a T account here for debit. The right side of the T account, as it says here, is the credit side. So that's what a T account is. You have the top. You'll have the name of the account, or what account you're analyzing. And then you'll have the debit on the left and the credit on the right. Next, double entry accounting system. We know that accrual accounting operates on a double entry accounting system. So pretty much long and short, what the double entry accounting system is, for every transaction, event, or arrangement that we account for, that means the total amounts of debits must always equal the total amounts of credits. So every time we make a debit, we have to make a credit as well. Okay, so double entry accounting system. Let's talk about some account classifications. Okay, account classifications, we can either have permanent accounts or we can have temporary accounts, right? Permanent accounts are going to be like your assets, liabilities, and equity accounts, all right? These are accounts whose balances at the end of the period are carried forward to the next period. So once again, balance sheet accounts are going to be permanent accounts. Once again, what's on the balance sheet? We have assets, liabilities, and equities, right? So those are permanent accounts. Those are carried from period to period, right? Which makes sense because we're accounting for those. That's our point in time. The balance sheet is a measure of point in time at the actual financial position. So those are going to be affected from period to period, but that's the position at a point in time. So those are permanent accounts. Balance sheet accounts, permanent accounts. Once again, they're assets, liabilities, and equities. Now let's talk about the temporary accounts known as periodic accounts, okay? Temporary accounts are going to be used to determine the changes in retained earnings that occur during a period. And these balances are not carried forward. So once again, temporal accounts or temporary accounts, these are going to be your income statement accounts, right? Your revenues, expenses, gains, and losses. And these have to be closed to your permanent accounts, okay? What's a contra account? A contra account is going to show a reduction in a related account. So a contra account meaning, so we have, so accumulated depreciation is a contra account, okay? So a contra account is going to be carried below, say we have a vehicle, right? Company vehicle. So we'll have a line item of which we're carrying at cost the company vehicles. And then right below that, and we know company vehicles is an asset, right? So it's a debit account. Well, the accumulated depreciation for company vehicles is a credit account. It's a contra account, meaning, and it's tied directly to that account. It's going to reduce the overall balance that is within the company vehicles asset account by the amount of the credit, okay? What's the debit side of the accumulated depreciation? When we record a depreciation expense for a period, we're going to debit the expense for the period, whatever we're allocating into the income statement based upon the systematic approach that we use for the type of depreciation that we use, meaning straight line or some of the year's digits, whatever it might be. The credit side of that, how we account for that, is going to be the credit for the accumulated depreciation. And we're going to get into that more in the future periods. Just for now, know that a contra account shows a reduction in a related account, okay? So balance. What is a balance account? This is going to be the difference between the total debits and credits recorded in that account, okay? So if we're making a journal entry and say, for example, if we need to balance the account out, if we've disposed of a fixed asset for something greater, the fair value is greater than the carrying value. So when we're selling that, we're going to debit cash because we've sold an asset, right? So we've debited cash, and then we want to credit the asset, the carrying value, right, to remove it off our books. But the difference between that has to be your plug, which is your balance, and that in this case is going to be a gain, right? Because we received more money than the value of what the item was on the books, right? So that's going to be a balance. That's going to be a balance account. In this case, it's going to be a gain because that's the difference. That's the balance to bring the debits and credits up to the right amount. Okay? Okay, let's talk a little more on the accounting equation and double entry system of accounting. So let's start here on the permanent accounts. Once again, permanent accounts are what? They're your balance sheet accounts. Balance sheet accounts are assets equals liabilities plus shareholders' equity. So these are permanent accounts, right? Let's start with the asset accounts. Okay, for asset accounts, debits are going to increase the asset account. Credits are going to decrease the asset account. Okay, and once again, this is going into the double entry accounting system. We're just seeing how it affects the accounting equation when you use the double entry accounting system. So once again, we're on permanent accounts. We're dealing with assets. If we debit an asset account, it's going to increase the value of that account. If we credit the asset account, it's going to decrease the value of that asset account. Next, liabilities. Once again, liabilities is a permanent account. If we want to decrease a liability account, we debit it. If we want to increase a liability account, we credited it. Next, shareholders' equity. This is once again a permanent account. It's carried on the balance sheet. These are going to be some of the components that we used, that we talked about earlier, of shareholders' equity. We have common stock, retained earnings, and accumulated other comprehensive income. We'll start with common stock. Debits are going to decrease common stock. Credits will increase common stock. Retained earnings. Debits decrease retained earnings. Credits increase retained earnings. Accumulated other comprehensive income accounts, we debit to decrease these, credit to increase these. So those are the permanent accounts and how the double entry accounting system affects the accounting equation based upon the permanent accounts, okay? Next, let's look at the temporary accounts. Once again, income statement accounts. These are the accounts that are closed to the permanent accounts at the end of the accounting period. Let's start with revenue accounts, okay? Debits decrease revenue accounts. Credits increase revenue accounts. Expense accounts. Debits increase expense accounts. Credits decrease expense accounts. Gain accounts. Debits decrease gain accounts. Credits increase gain accounts. Notice here, remember revenues? This is money. We're making money, right? Gains, we're making money. Look at the similarities between the two. To reduce a revenue account and to reduce a gain account, we debit it. To increase a revenue account, to decrease a revenue account, to increase a revenue account, to increase a gain account, we increase it, we credit it. Okay, now let's look at the loss accounts. To decrease a loss account, we credit it. To increase the loss account, we debit it. Okay, let's look at the expense account here. Remember, losses and expenses, that's going to be money going out, right? That's money that's going to reduce our net income. So let's look, expense accounts, to increase the expense account, we debit it. To increase the loss account, we debit it. Same thing, to decrease the loss account, we credit it. To decrease the expense account, we credit it. So expenses and losses operate the same with debits and credits, the increase, decrease. Same with gains and revenues. They operate the same with the debits and credits, the increase or decrease, okay? Next, dividend account. Debit increases the dividend account. Credit decreases it. Okay, I cannot stress enough how important this slide number 13 is here. This is so imperative that you understand this right here. Okay? Really know, A, the differences between permanent accounts and temporary accounts. Okay? And then know how it affects the accounting equation by the double entry system. Okay? Meaning assets, okay? The original debits. Debits increase, and it should be a debit balance, right? Revenues. Debit decreases, it credit increases, so on and so forth, okay? Once again, we just went through it. I'm not going through it again. Study this, okay? Know it. It's going to make your life so much easier. Let's talk about the financial statements. Remember, this is the output of the accounting system. The annual report, what is it? It contains the financial statements for the fiscal year, the supporting schedules and notes, management's discussion and analysis, and other information, okay? Interim statements or quarterly statements. These are going to be financial statements prepared for shorter time periods, okay? These are more for internal use, for decision making, okay? So these are going to be interim financial statements. Annual report's going to be much more important. Obviously, this is what the external users are going to use. Interim statements, more for internal purposes. These are more accurate than these are. It's just a little bit of a difference between the two. Okay, the accounting cycle. This moves on to learning objective number 2, okay? Step 1, record the transactions, events, and arrangements in the journal, okay? So we've established that already. Step 2, post the journal entries to the accounts and the ledger. The third step, prepare and post adjusting entries. We know what the adjusting entries are by this point. Step 4, prepare the financial statements. And step 5, prepare and post closing entries for the temporary accounts. Once again, remember, temporary accounts are what? These are going to be your operational accounts on your income statement. Revenues, expenses, gains, losses, and dividends, okay? So once again, that is the accounting cycle. So we know we're talking about the accounting systems here. So we want to know exactly, we know we're taking this stuff from a transaction from the point of sale, right? And we're worried about how it's going to flow all the way to the financial statement. So that's, in effect, what an accounting system does. It accounts for transactions, okay? Then it runs it through a whole process within the system. And then the output, once again, remember, is the financial statements for the external users for decisions, right? So this right here is just a little bit of how the accounting information flows through the accounting system, okay? So once again, remember, we're going from the transaction at the point of sale all the way to the end result of the financial statements when it's reported in financial statements. So how's that accomplished within this system? Let's just see what's happening pretty much behind the scenes here within this accounting system of how the accounting information flows through it. So you can see here, we'll start on the left. We have the transaction, right? So here we're actually purchasing inventory on credit, right? So we're purchasing inventory on credit. What that means is we're not paying the supplier up front. We're going to receive the inventory, but they're extending it to us on a line of credit. So we're going to pay them later for it, right? And they invoiced us for $100. So that's how much this transaction was for $100. Remember, we're purchasing inventory on account. So how do we record that in a journal? We're going to debit inventory. That's our asset. It's increasing. Remember, debits increase assets. So we're debiting inventory for $100. The credit to that debit is going to be accounts payable of $100 because we've incurred a liability. Remember, accounts payable is a liability. Liabilities are original credit balances. Credit entries increase liabilities. So if we're receiving inventory on credit for $100, we're receiving an asset of inventory of $100. We debit inventory $100. We've increased our inventory, the asset, by $100. But we've also incurred the liability, so we have to credit accounts payable for $100 because we owe that supplier $100 for the inventory that we've received, okay? So that's how we record that transaction in the journal. Next, it's going to be stored in accounts, okay? Obviously, the accounts that we did and the accounts we used on the journal entry, inventory and accounts payable, are going to be the accounts in which they're stored, right? So in this case, you can see here, these are the little T accounts, right? Remember we talked about T accounts? We have the name on top of the account, which in this case is inventory. And then we have the debit side and the credit side, right? Same thing down here for the liability account of accounts payable. You have the debit side, the credit side. So it makes sense. If we debited inventory for $100, it's going to be stored in the account on the debit side in the relevant account of inventory of the T account. That's why it's on the left-hand side on the debit side. Same thing. In the journal, we recorded accounts payable as a credit of $100. So it's going to be stored in the accounts under the accounts payable T account on the credit side of $100. Okay? So now what about, how's that going to be reflective in the financials, okay? So it's going to be reported in the financial statements, okay? So the inventory is what? It's an asset, right? Assets are carried on the balance sheet, okay? In particular, inventory is a current asset, okay? So as you can see here, it's going to be reported in the financial statements on the balance sheet under current assets, okay? We're concerned with inventory. It's $100. So it's going to be carried as a line item of inventory of $100 on the balance sheet under the current assets section of the balance sheet. Next, accounts payable. Remember, accounts payable is a liability. Liabilities are reported on the balance sheet. Accounts payable in particular is a current liability. So it's going to be in the liabilities section of the balance sheet, in particular the current liabilities section of accounts payable, a line item of $100. So we can see here how the accounting information flows through the accounting system from the point of sale, meaning the transaction, to how it goes through the journal, how it's stored in the accounts, and ultimately how it's reflective within the financials. Okay? Once again, this is very important here as well. Let's learn on to the objective number 3. Move on to that. Learning objective number 3, recording entries in the general journal. Okay, recording entries in the general journal. Okay, so the general journal consists of a column for the date, the titles of the accounts affected by each entry, the account numbers, debit amounts, and credit amounts. Okay. So each transaction is recorded in the general journal with the journal entry. Okay. And then there's usually a short explanation that's going to be written below each journal entry, just so we have an idea. So, because we're going to have a lot of journal entries, right? So we just want to have a general idea of a little memorandum of what happened with that journal entry. Okay, that's all that's saying there. So let's illustrate the accounting cycle for a second. Okay, so Jamie Corporation incorporates on January 1, 2019 as a wholesaler. Okay. The company uses a perpetual inventory system. A perpetual inventory system is one in which the inventory account is going to be updated for each purchase or sale. So it's perpetually, okay? So within accounting, we either have a perpetual inventory system or a periodic inventory system, okay? Perpetual meaning it's updated in real time. So every time you purchase a good or you sell a good, it's going to be updated, meaning you're going to incur cost of goods sold and reduce inventory, okay? Recognize your sales revenue and your expense, whatever it might be, okay? So that's perpetually. It's perpetually happening one after the other. Periodic, at the beginning of a period, say January 1, we count inventory on hand, okay? Then we go through the whole entire period. It's not accounted for by sale, but then at the end of the period, then we're going to count the ending balance, okay? That's a periodic inventory system. Periodic, counted at one period as opposed to another period, account for the change, make your adjusting entry. Perpetual inventory system, it happens in real time, perpetually every time a good is purchased or sold, okay? So what are going to be some of the accounts that we're going to be concerned with involving inventory transactions? Okay, so accounts used in inventory transactions are going to include purchase returns. What do you think purchase returns would be? Okay, so this is going to be inventory return to receive a refund. So say if you purchase a pair of shoes from a store and you're just not happy with them, okay? And you haven't worn them yet, and you just say, you know what, I don't want these, I'm going to return them, I'm going to get my money back. So that's what purchase returns are for, okay? So obviously if we're a company and we're selling an item, there's a chance that it could be returned based upon our policy of how we handle returns, right? Purchase allowance, what is this? company keeps damaged inventory and receives a refund, right? So purchase allowance. So we, in this case, say we received damaged inventory. We're gonna keep that damaged inventory, and then we're gonna receive a refund from the company because of it being damaged. So that's a purchase allowance. Okay. Purchase discounts. Okay. This is going to be a discount offered by the supplier to induce prompt payment. So purchase discounts. Sure, y'all probably heard of like 210 net 30 for selling terms. If you haven't, 210, what does that mean? 210 net 30. 210 means that, say that I'll sell you something, if I sell you a good on like January 10th, okay? 210 means if you pay me in full within 10 days of that business transaction, I'm going to give you a 2% off. 210, okay? What does net 30 mean? Net 30 means that's the net of the payment, like we're not even giving you a discount, is going to be due within 30 days, right? So before it's considered a late payment, right? So purchase discount 210, that's if you pay within 10 days, you get 2% off. Net 30, that's when the net amount's due without the discount within 30 days, okay? So once again, the accounts that are going to be used in inventory transactions include purchase returns, discounts, and allowances, right? So it says here, during 2019, Jamie engaged in various transactions. So let's just take a look at a couple transactions here of how we prepare journal entries, and then we're going to wrap up this part of the lecture for chapter 3. So it says here, preparing journal entries, part 1. Okay, look here, we have the date, January 1. It gives us the transaction and then the analysis, okay? And then here's going to show the actual, the recording of this transaction. This is just analyzing what's going on, okay? Same thing here. There's another date, another transaction. So this is giving you the transaction. This is the analysis of what's going on, and this is how we account for it within the journal entry, okay? So let's start up here at the top, okay? So it says here on January 1, the transaction that we're going to account for, it says various shareholders invest in Jamie by purchasing 2,000 shares of no par stock at $10 per share. Okay? So what are we going to do here? So it says here, asset account, the cash is going to increase, debited by 20,000. So various shareholders invest Jamie by purchasing 2,000 shares, no par at 20 per share, or 10 per share. So 2,000 times 10 is $20,000, right? So we're going to debit cash because we're receiving cash. So the asset account cash increases by 20,000. That's why we're debiting it, right? You can see here, here's the date, January 1 of 2019. We're receiving cash, 2,000 shares at $10 each. So that's 20,000. We've received cash, and we have issued, right? Shareholders' equity account of common stock increased by 20,000 because they purchased 2,000 shares of no par stock, right? So we the company are receiving cash. We debit cash. It's money coming in. Remember, cash is an asset. Assets are debits to increase it. So we debit cash, $20,000. We issued common stock. So we credit common stock for $20,000. So right here, we made our little memorandum here, a little note. Issued 2,000 shares of no par stock at $10 per share. Okay, so once again, we issued stock, we're receiving cash, we debit it, and we credit common stock because we're issuing common stock, we're crediting it. Because remember, common stock is a component of shareholders' equity. Equities are credits, so that's why we're crediting that. Next, January 16th, Jamie purchases 2 acres of land as a building site, paying $1,500 an acre. Okay, so what's the entry here? So once again, remember we purchased 2 acres of land for $1,500 per acre. So $1,500 times 2 is $3,000. We're receiving an asset of land, right? Remember, Jamie purchased 2 acres of land, so we're receiving land for the full amount. Remember, 1,500 times 2 acres, 3,000. So we're receiving an asset, land, debit, assets increase, so debit, it's going up, land's increasing 3,000. And we purchased it with land, right? We paid $1,500 an acre. So cash is an asset, it's decreasing, it's going out, so we have to credit it for $3,000. So once again, the asset account land increased by $3,000 by debiting it. Cash decreased by crediting it $3,000. Let's look at some more transactions. On March 30th, Jamie purchases a building and equipment for $15,320 and $2,120 respectively. Okay, when you see respectively, I'm sure everyone knows it's meaning, okay, they listed building and equipment first. So the building and equipment is going to be the first price. Equipment is going to be the next price. That's what respectively means. When they list them in order and then put respectively, so if they list the assets and then the amounts after, and then put respectively, you go in the order in which they're listed. Building equipment's first, that's why it's this. Equipment's next, that's why it's that amount. So it says Jamie pays $10,840 and signs a 12% note, interest and principal to be paid after 2 years for the $6,600 balance remaining left over. Okay, so once again, remember it says Jamie purchased building and equipment for $15,320 and $2,120 respectively. So obviously the building, we're receiving building and equipment because that's what they purchased, right? So the building was worth $15,320. That's why we're debiting the building for that amount because it's an asset. It's increasing by debiting it, okay? Equipment increases by $2,120 because that's how much it costs. So we're receiving the asset equipment, so we debit it by $2,120. Remember, she paid $10,840 in cash. So we have to reduce the asset to cash, money going out, $10,840. Then the rest of it, remember, we incurred a liability because we signed a 12% note, interest and principal to be paid after 2 years for the remaining balance. Remember, that's a liability. Liabilities are credit balances. So we're going to increase our liabilities with the notes payable of the $6,600. So once again, we've purchased the building and equipment by paying cash of that amount and notes payable by that amount. Okay? Next, March 30th, Jamie purchases a 1-year comprehensive insurance policy for $360. Okay? So if we're buying a 1-year comprehensive insurance policy at this date, obviously this is going to benefit the whole entire 1-year policy in which we purchased it, right? So obviously we're receiving an asset out of something. If we're buying a policy, that's going to be an asset to the company, right? So we have a right to use that insurance. So we're going to count it as a prepaid insurance, which is an expense, right? Because remember, prepaids, if you recall from principles, prepaid expenses are going to be assets. So once again, we purchased a 1-year comprehensive insurance policy for $360, right? So we're receiving the right to use that policy for a year. So we prepaid the insurance, which is an asset. We increased it by debiting it $360, and we paid cash for it. So we're reducing cash, money going out, by $360, okay? So once again, the asset account prepaid insurance is debited or increased by $360. Cash is decreased or credited by $360, okay? Okay, let's look at one more little example here, and this will be the quitting point for today, and we'll pick back up on slide 22 on Wednesday. So let's go through just a couple more here just so we can get a little more practice here. So let's say now on March 31st, the transaction is that Jamie purchases $7,300 of inventory on credit from Bark Company. So, okay, now Jamie purchases that amount of inventory, $7,300 worth of inventory on credit from Bark Company. So Jamie's receiving an asset of inventory of $7,300, right? So she's going to debit inventory because remember, assets are debits to increase it. We're receiving it, so we're increasing the inventory account, debiting it $7,300. And remember, we've incurred a liability because we did it on credit from Bark Company, right? So we still owe Bark for the inventory they gave us. So we've incurred a liability. Remember, liabilities are credit balances to increase it. In particular, it's an account payable because we owe Bark Company for the inventory in which we've received. So we debit the inventory, received it, $7,300, that's increasing it. Credit accounts payable for the liability that we've incurred of $7,300 because that's how we keep track of owing Bark for the inventory we received. Once again, the memorandum is purchased inventory on credit from Bark Company. Okay, now on April 2nd, Jamie sells inventory for $8,000 cash. The cost of the inventory was $5,090, okay? So if Jamie is selling the inventory for $8,000 cash, okay, so that means Jamie is now receiving money, right? Receiving cash. Cash is an asset, right? Debits increase assets, right? So if Jamie's receiving cash, she wants to debit cash for the amount received, in this case, $8,000. Now, Jamie is also going to count revenue here because remember, she sold inventory. She's in business to sell her inventory. So when we receive the cash, the credit entry to that is going to be sales revenue of $8,000 because revenues is going to be $8,000, which is the cash brought in from the sale of the inventory. Okay, now it says the cost of the inventory was $5,090. It's not showing here, but the entry on a perpetual system is going to be to debit cost of goods sold, which is, remember, expenses are increased by debits. So cost of goods sold would be $5,090, and then credit inventory to decrease it by $5,090. Okay. So once again, this is how you prepare journal entries based upon transactions and events that take place. And you can see here by us preparing these why it's so important to know what elements are assets to increase and what elements are credits to increase, or vice versa. What assets decrease and credits increase. Okay. So really spend some time on this lecture, really know the difference in how the accounting equation is affected by these different elements and transactions, learn your terminology, and really learn the difference between your temporary and permanent accounts and how they're affected by the double entry accounting, meaning by what accounts are increased by debits and credits and what accounts are going to be decreased by debits and credits. Once again, that's the end of this part of Chapter 3. That's Part 1 of Chapter 3. We'll be picking up on slide 22 on Wednesday for that Wednesday's class and go through about another third of this lecture, and then we'll wrap this chapter up on Friday. I will be posting the quiz and the homeworks for this chapter here relatively soon, so you have that to be working on as we move through this chapter, and I'll make sure you have plenty of time to get that in as well. So once again, that's the first part of Chapter 3. I hope it makes sense to everybody. If not, remember you can always reach out to me. I'm here to help you. I want to help you. So just shoot me an email if you're having trouble. Come by, see me in my office hours. Once again, I apologize for having to cancel class today. Hopefully we'll be back in the classroom on Wednesday. If not, I'll keep you posted. But just be on the lookout for this lecture and the homework and the quizzes. And once again, please reach out to me if you need help with anything. Thank you again for your time, and I'll see everyone on Wednesday.